Now, today we delve into Nigeria's capital market with a particular focus on the equities market, which was a beacon of resilience and growth in 2024. The Nigerian stock market closed the year with an impressive 37.65% return, positioning it among the top three globally in terms of performance. This remarkable feat highlights the strength and potential of Nigeria's equities market, even amidst global economic uncertainties. We will explore the factors behind this success, the challenges faced, and what lies ahead for investors and stakeholders. Now, joining us from Lagos is Johnson Chukwu. He's an economy and financial expert and CEO of Cowrie Assets Management Limited. Well, it's good to see you in the new year.
Having me. Happy New Year.
Same to you there. Well, to delve into the subject matter, last year or towards the end of last year, we've seen quite a remarkable performance by the equities market, and now the same feed has continued in 2024. What were the key factors that drove the Nigerian equities market to achieve such a stellar performance in 2024?
There are multiple factors that one could attribute to the exceptional performance of the Nigerian equities market in 2024. Of course, the market actually achieved a 37.65% year capital appreciation in 2024, which is materially higher than the 34.6% inflation rate. So the equities market was the only segment of investment instruments that had performed the inflation rate in the economy last year. But back to your question, what are those factors that could be attributed to this stellar performance? One, we saw good results by a number of quoted companies. We saw half-year and third quarter report performances by the number of quoted companies. We saw very mouth-watering benefit payment half-year, that is interim dividend payment by a number of companies. These are some of the factors that incentivize investors to go back into the equities market, despite the very high return on fixed income instruments. Ordinarily, in an economy where you have high yield on fixed income instruments, equity market don't perform well. And then we also have to deal with what I call shared economy. Lots of liquidity came into the economy from sources that we're yet to place our hands on, but principally from, I believe, from public sector entities or institutions. So that could have contributed to the market rallies. But most importantly, the fundamentals of the market are strong. Yield, return on investment is strong, dividend payment is strong, and the outlook is that if you look at the third quarter result of most of the quoted companies, the outlook is that performances at the full year of these companies will also be strong, and benefit payment will further improve.
Now, how does this compare to previous years, and what does it say about investor confidence at the moment?
Well, if you look back at 2023, the market gained about 45.9% in 2023. And if you add that to this gain of about 37.65%, you are talking of a market gain in the region of 80%. There's over the past 2 years. What this means is that investors have strong confidence in equity instruments. Benefit payment have been quite strong. Dividend payment have been quite strong. And then last year, we also saw some strategic changes in some of the counters, some of the quoted companies. Take, for instance, a Seplat, the successful acquisition of Mobile reflected in investors' interest in Seplat. If you go to the likes of Oando, the acquisition of also major assets could have also contributed to market interest, investors' interest in them. And then if you go to the banks have actually enjoyed the tailwind effects of current monetary policies, where yield on fixed income instruments are quite high, and the banks do not have to take so much of credit risk to be able to make money. And you can see the banks are making very huge profit. So that also incentivized investors. So if you look at the economy, you can see sector that are both very strong outlook and also performed well over the past couple of years. The agricultural sector, the likes of Presco, the likes of Okomo. And then if you go to the banking sector, I just mentioned, talked about the banks, you talked about the oil and gas sector. So those sectors have been major pullers in the market, or major drivers in the market.
Stocks. What about stocks? You mentioned sectors that have contributed so much to the growth of the equities market in 2024. What about stocks? Which one had the most impact?
Well, if you're talking of the ones with the highest gain and the highest loss are what they call the leaders and the laggards. You saw the insurance industry; some of their counters were quite strong. You saw Oando was among one of the leaders in the market in terms of market gain. Oando gained over 500% last year. You talk of the likes of, like I said, the number of insurance companies did quite well in terms of market gain. Then if you talk of the laggards, you talk of the likes of Ray Power and a couple of them that lag behind, but Northern Flour Mills also lag behind. But the basic thing is that you have market leaders in terms of appreciation across a number of sectors. The oil and gas sector was among them, the insurance sector among them, even some stock that used to be penny stocks recorded very significant gain last year.
Okay, well, in terms of macroeconomic policies, how much do you think has impacted in the market?
Well, if you look at macroeconomic policies, so you're looking at inflation policies at relates to inflation, driving inflation or moderating inflation, interest rates, exchange rates. One would say that what ordinarily should have impacted the equities market negatively, which is the interest rate policy of the central bank, interestingly, did not so much affect the market. Like I said earlier, when you have high interest rate environment, what happens, investors will underweight their portfolios in equities and move to fixed income. But interestingly, the equity market is the one that actually outperformed inflation because people want to have some assurance. I did say earlier that the equities market gained about 37.65% last year. Contrary, I mean, if you compare that to an inflation rate as of November of 34.6%, the equity market, anybody who invested in a basket of equities actually outperformed the market. But I think the other factors beyond monetary policies are the factor that drove performance of the market, because ordinarily the monetary policies should have dampened equity market performance in 2024.
Okay, now despite the impressive performance, what challenges did the equities market face in 2024?
Well, the changes, they were able to sidestep it. One of the core challenges that would ordinarily have affected to take deposits that are close to 30%. And ordinarily, that should have made people underweight their portfolios in equities. Apart from that, I think the policy of the central bank to insist that the banks have to increase their shareholders' fund to 200 billion for national banks to 500 billion
Yes.
for international banks or banks with foreign operation ordinarily had a negative weight on the market at the beginning of last year. And because investors were not sure that the banks could weather or side or be able to continue to perform well with such policy. Because you bear in mind that central bank had also said that reserves of the banks would not count, that the revenue reserves of the banks, other than share premium, would not count as part of the shareholders fund. That had a dampening effect on the market in the second quarter of last year. But the market was able to overcome that, and because the banks continue to post very positive returns, and the banks have actually proven with their capital raising that they have the capacity to meet that new capital, central bank new capital requirement, which I think they were given 2 years to achieve by March 2026. So that was one of those two factors: monetary policy to high interest rate environment, high yield on treasury bills, as well as the policy on recapitalization of the banks had some dampening effect on the banks, on the equities market, but the equities market was able to sustain that and still record very impressive performance last year.
Now, talking about opportunities, what opportunities can stakeholders leverage in the equities market in 2025?
That takes us to the sector that we think should do well. I think the agriculture sector will continue to do well because we have we have been facing severe food challenges or food insecurity. So there is clearly demand for agricultural items far more than the supply. So the sector should continue to. The oil and gas sector, I think, particularly the fully integrated companies, those in the upstream sector, will do well. We've seen some improvement in security in the Niger Delta regions, which ordinarily should lead to improvement in crude production, particularly for those locals. I did say earlier that Seplat acquired Mobile, while Oando also did a huge acquisition last year. So those ordinarily should begin to mine or exploit and produce from those fields they've acquired. Then that means that sector should do well. Then we are looking at, if you look at the banking industry, most of the banks have come to the market to raise money. So the challenge or threat of non-meeting capital requirement have largely been addressed. So I think that sector will also leverage on the current monetary policy environment to also do well.
Now, do you anticipate any policy or regulatory changes that could influence market dynamics this year?
Well, there is already one. The insurance sector has a new capital requirement, which I think for composite insurance companies, they need to raise about 15 billion or so. I think 25 billion. Yeah, 15 billion for non-life and 10 billion for life. And I think for reinsurance.
Okay, I'm afraid we have to leave it there, Mr. Johnson Chukwu. It's a pleasure having you in the program. Now, for global stocks, so eyes are on the Eurozone's harmonized index of consumer prices due later today.